Hi everyone, my name is Singi and I am an investment analyst at St. James's Place Asia. 2021 has been yet another extraordinary year, from rising inflation and energy crisis to regulatory crackdowns. What are the key events that happened in the past year that could impact our year ahead? I'm joined by Martin Hennecke today, Head of Asia Investment Advisory and Communications, to provide us with his views from the top. So Martin, inflation surprised many people in 2021, and the Fed officially decided to retire the word transitory in December. What is your view on the inflation outlook for 2022 and beyond? Do you think the Fed has it under better control now, with signals of accelerated taper and the possibility of 3 rate hikes in 2022?
Thanks, Jinyi. Well, I would suggest that inflation is still something to be watched out for, even though the Fed has been talking about tapering, and we have seen the Bank of England increase interest rates as well. But two factors cause me still some worry on the medium to longer term inflation outlook. Now, firstly, that's China, and in China, it's for once the demographic picture has been changing. So basically, China for decades has been exporting deflation to the world, basically. But now population growth has been peaking. It's the lowest since 1953. Last year, we have actually seen the fertility rate drop to 1.3, which is very low. And again, this year, the first 3 quarters marriage rate dropped to a 13-year low as well. And I think that's one factor sort of in terms of cost pressures coming out of China growing. And the other one is China's quite ambitious aims to turn green in terms of clean energy, using less energy, quality of doing business over quantity of production and doing business. And all of this has led sort of to an increase in cost, which might persist. And thereby, I think what we are starting to see is a longer-term shift of China turning in an exporter of inflation rather than deflation. The other thing, something quite unrelated, is basically debt and deficits pictures in some of the major economies in the world. So we have actually had Alan Greenspan, even before COVID, warning quite clearly in February 2020, before it got really underway. And he was saying in a quote here, "Unless we bring those extraordinary budget deficits under control, history tells us that there's going to be a much more rapid increase of price increases than we have seen." So basically suggesting high US budget deficits actually are another factor driving inflation. Subsequent to this, obviously, with COVID, you've seen the budget deficit that was around the 1 trillion mark at that time jumped to 3.1 trillion the following year, then 2.71 trillion the financial year that ended earlier in September. For this financial year, it's going to drop back again, but it's still clearly going to be above the 1 trillion mark. And this debt and deficit issue actually also is a factor that I think possibly give much less room for the central banks to maneuver in terms of interest rates increases if inflation really, continue to be persistent. Because at the current debt level, if interest rates were increased back up to historically average levels, it could trigger a debt crisis as well. So I think they're a bit stuck here between a rock and a hard place and not quite willing to admit it. And all of that means to me that inflationary risk is still something here to be reckoned with. And it's not just the US, the ECB, for example, also was reported by Bloomberg in October to be considering a new larger QE if the current rollback plans of QE led to higher interest rates on some of the more indebted European countries. Now, what does that all that mean? Practically, I wouldn't suggest investors to speculate or gamble on rates not increasing or inflation necessarily surging. Nobody knows, for 100% certain what will happen. And I would also be careful with leverage generally and stay diversified, etc., etc. But my main point here is that I still think holding too much exposure to cash also holds risks that one needs to be very conscious of, and namely that's the quite high degree now of negative real interest rates we are seeing, given the gap of inflation, very significant gap of inflation, and the interest rates level we are seeing, even if there were a few minor increases in the near future.
Right. Martin, in that case, what does that all mean for the markets?
Well, one interesting aspect here, and I just like to cite a question I received in this survey, in an industry survey. It just popped into my inbox earlier this week. And the question was what level of US inflation could derail the equity bull market? And I think this question is actually a little bit misconceived. I mean, in the short term, it's very difficult to predict the relationship of equity markets and inflation. But medium to long term, what typically happens is that companies that do have an edge in the market actually tend to have the ability to pass on rising input costs to consumers in the form of rising prices. In fact, Warren Buffett summed that up in April this year when he was saying at the annual shareholder meeting in a very brief, nice sentence, we are raising prices, people are raising prices to us, and it's being accepted. And he's talking here about his businesses doing that, and that is just being accepted to be passed on. We also had on 2nd of December a survey of chief financial officers from the Federal Reserve Bank of Richmond released, where they were saying that 80% of businesses are actually passing on costs, not all fully, some to some extent, but basically they're passing on rising costs to consumers in the form of higher prices. And that means from an investor's perspective, equities generally are relatively more inflation-proof again than cash or also fixed interest. So they can form part of an important hedge against inflationary risks in diversified portfolios.
Right, thanks, Martin. So moving on, besides inflation that we touched on, I'm sure you agree with me that another major theme in 2021 is on China, which you briefly mentioned. So in fact, in 2021, two of the big scares that we saw was both came up from China. So first of all, we had the regulatory crackdowns in both the technology and education sectors. And second, we have the Evergrande crisis. So what is your view on China from here going forward? And how do you think it might impact global markets?
Well, the first thing I would like to note on this one is that generally speaking, whenever a market has dropped, in the recent year or relatively recent time frame, there's this risk that investors project what has happened recently to the future, as well as called recency bias, and it's quite easy to get caught into this. So what it means is that whenever a sector is very popular and hot and has been rising a lot, people want to buy it, and vice versa. If there is something that has dropped a lot and there are negative headlines, people may want to sell it, but price is not fully considered very often, and also that things might be changing. So in terms of those two crises that you just cited there, Xinyi, on China last year, I think actually a brief comment on that. They're also somewhat related, as I would see, because the regulatory crackdown and then the Evergrande crisis both sort of had the aim of limiting moral hazard and of rolling back some relatively easy policies and bubble risk in some areas as well. I also think it's somewhat related, or some of them, to the demographics challenges that we have seen. And so longer term, some of those changes might actually benefit the wider society and thereby the consumption strengths and economy in the longer term. More short term, this view to 2022, another thing I'd just like to emphasize that most recently the rhetoric coming out of China has been to emphasize the focus will be on stability now. We have also seen a cut in the lending rate for the first time in 20 months. Just now, it was just from 3.85 to 3.8, so not a massive shift, but the psychological significance, I think, might be quite high. So we might see a little bit of an easier going central bank, a little bit of an easier going political front possibly as well, and valuations have, of course, dropped in the past year. So, long story short, I would suggest not to, exclude it from portfolios, and where opportunities might present itself, that some China exposure, where good companies are being identified, can still be held as part of a diversified portfolio approach.
Yes, I think that's very well said. At St. James's Place, we believe that taking a diversified approach can actually lead to better client outcomes. So thank you for your time today, Martin. It's a pleasure to speak to you. As we are fast approaching 2022, it is never a better time to review your finances in the new year. Take control of your financial futures today and speak to your St. James's Place partner or contact us at info@sjp.asia.